Pastoral Profit webinar, Funding Your Business for the Future, Another Step Towards Creating an Economically Sustainable Business. I'd just like to run through some GoToWebinar housekeeping to start with. So firstly, there is the red button with the arrow on it, which opens and hides your control panel. This might the arrow might close your control panel, and all you need to do is press that button again to fix that. Secondly, you can choose two audio options today. There's the telephone and mic, and the mic and speakers. If you find that the mic and speakers is getting a bit distorted, then the telephone is the best option to use. So you're muted today, but how you can talk to and interact with us today is through the questions panel. So that's the way you can submit and comment via the question panel. Also, if you can't hear us, please type in the question box. But I just want to make sure that you can all hear me today. I'm wondering whether you can just raise your hand via the little hand and button, and yeah, so please raise your hand. Great, I can see a few of you can hear me. Awesome. If you don't mind then pressing that button again, and that will lower your hand. Great, thank you. So there's also the option to use GoToWebinar via your iPhone or your iPad, and you can type in the questions by pressing the little question mark and raising your hand by pressing the hand. So that's the end of the GoTo housekeeping. So we're going to go into funding your business for the future, another step towards creating an economically sustainable business. My name's Penny Keynes. I'm the Pastoral Profit National Coordinator, and I'm your facilitator today. I'm based in Clare in South Australia. So a little bit about Pastoral Profit for those of you who weren't involved in the last webinar and aren't aware of what Pastoral Profit is. It's a new joint initiative between Meat and Livestock Australia and Australian Wool Innovation, and so they've jointly funded this program to address the problem of declining profitability in the pastoral zone. So this program is really customised to meet the needs of the region, and it's looking at and focusing on targeting business management skills to really improve pastoral businesses' bottom lines. So that's sort of where the program is targeting, and yeah, it's seen as an opportunity for development in the pastoral zone, is that business management skills. So I'll have a little bit more information on what some of these activities might look like, but we really need to, and I want to reiterate that this is customised for the region, so it's really dependent on what producers want and need. And so if you're a producer and you're interested in being involved, we really want to connect with you to find out what it is that you need. So how you can do that is that we've got regional coordinators in each of the states, and I'll just go through a bit about what each of them have got planned. So Pastoral Profit in Queensland is managed by Heather Smith, and she's going to be putting on some business bootcamp workshops in early October in 7 proposed locations. So Bolin, the list is just up there, but if you want to come back to it, have a look at these slides again, then that those are the locations that she's suggesting. But emerging themes are financial literacy and the language of money, management accounts and how to use them, determining the profit drivers in your business, evaluating capital investment, and is it the best use of your funds, and understanding them and managing your business, your bank relationship. So this is really is the program will obviously develop, but if you'd like to have a hand in helping Heather to do this, then feel free to get in contact with her, and there'll also be a chance then to look at how the program runs out for the rest of the for the rest of the year. So Pastoral Profit in New South Wales is managed by Mark Gardner, and Mark is looking at working with clusters of producers in a few different regions across New South Wales, Burke and Broken Hill, Cobar, Walgett and Hay, and it's really, he's working with these to form some, to work out what the emerging themes are. So strategic planning, innovative marketing, benchmarking and profit drivers and succession planning are all quite on the top of the list for those areas. But there's also some early planning for a technology and innovation forum at Nyngan and Broken Hill. So Mark would really be keen to find out if you want to be link in with one of these clusters, or if you're interested in forming a cluster in your own region that's outside of this area. So Mark's contact details are just there. Anne Collins is in South Australia, and she's been working on a lot of different things, but at the moment we can only really talk about this one solid plan, and that's the forum in partnership with some forums in partnership with South Australian Arid Lands Natural Resource Management. So they're to be run in October, and locations are Flinders Ranges, Northwest Pastoral and Gawler Ranges, and they're looking, these activities are sort of looking at financial literacy, understanding business key performance indicators, and then there might be some other spin-off activities on communication and effective communication, cost of capital allocation, enterprise selection, for instance. So getting in touch with Anne. And finally, we've got Western Australia. Our coordinator there is John Duff, and he's been working with Rangelands NRM in WA and recognised biosecurity associations to coordinate some innovation expos around some key themes of business planning, finance structures, benchmarking performance, and it also includes components of what to expect from pastoral profit in the years to come. But there'll also be some innovative topics that come from the Rangelands NRM and the recognised biosecurity association. So there'll be the one solid one that's locked in is Kalgoorlie on the 22nd and 23rd of September, and then there'll be one in Mount Magnet and Carnarvon, but those dates haven't been set yet. So that's a bit of information about what, and very broad about what is coming up, but very keen to hear from you and for you to get in touch with these people to find, to let them know about what kind of activities you'd like to see delivered. So we'll be keeping the website updated with information as these plans become more solid, but also I'll be sending out some e-newsletters just to keep you informed of what the activities are going to be. So this webinar today is following the first webinar on the foundations of creating an economically sustainable livestock business in the pastoral zone, and in that webinar Phil Holmes covered what it means to be financially literate, how to be economically sustainable in the long term, and a few of those key things. So Phil has kindly and very generously come back on today to go into a bit more detail about this, but I encourage you, if you haven't seen the first webinar already, it really gives you a very broad overview of what it means to be economically sustainable. So make sure you go back to the Pastoral Profit website, www.pastoralprofit.com.au, and that's where the recording is available. So just before I introduce Phil, I'd really like to find out a little bit more about where you're all from. So I'm just going to run a poll and have you answer that poll, if you wouldn't mind just selecting which area you're from. Great. We've got 84%, 90% voted. Awesome, thank you. So I'll just close that off and share that information. So we have a big contingent, over nearly 50% from Queensland. We've got 25% from New South Wales, 9% South Australia, 5% Western Australia, and 14% from other states. So that's really interesting to know, and I appreciate you answering that question for me. And we've got 62 attendees online today, which is a great number. So just wait for that slide to come back up. So I'll just... So Dr Phil Holmes is from Holmes Company, and he's here to talk to us about determining the capacity of the business to fund future liabilities. Phil is the principal consultant for Holmes Company, a Sydney and Wagga-based firm, providing business advice to corporate and family-owned businesses in all states of Australia. Phil's special interests are in commercial beef and wool production, agricultural sustainability, finance and equity investing. So during this webinar, we're going to ask you to type in some questions if you have any throughout, and if time allows it, we'll have some questions and answers today. So keep those questions coming in as we go. Phil, I've just unmuted you. How are you going today?
Penny, I'm well, thank you. Good to be here.
Great, thanks for joining us again.
No worries.
And secondly, we're just going to do a little bit of a different format to our last webinar, and we're going to introduce Alex Morgan, our producer, today. So Alex is from Outalpa Station via Alari in South Australia, and she manages her station with James and her husband and her son Ed. Hi Alex, how are you?
Very well, thank you, Penny. Good afternoon, everyone.
So Phil, I might just let you ask Alex a few questions now.
Okay, it'd be interesting to hear the Outalpa story. So Alex, how long have you been managing your business with your husband and family at Outalpa?
We purchased Outalpa in October '96, so about 18, 19 years.
Yeah, righto. And in that 18 or 19 years, did you ever seriously question whether pastoralism was your future as your family, and it would be able to provide for the needs of the family in the future?
Yes, we did. We just embarked on a new business, obviously, and in the late 90s and early 2000s it was incredibly challenging. We weren't really necessarily under financial duress, but it was definitely a period of low returns and very dry seasons, and clearly unless we changed some things, we were not going to achieve our long-term goals, which were obviously things like educating children, investing off farm, you know, providing for our future. And retirement, and yeah, so we loved our life in the bush and friends and community, and we're heavily committed to the industry, but we were also very concerned about what the future held for us and whether the workload that we had was actually sustainable.
Okay, and when you were thinking about all of that, did you assume then that if you made the business efficient and profitable, it would generate the funds needed, or did you go further than making that assumption?
We did a lot of analysis and budgets on different scenarios. We analysed the wool market and questioned why it was historically at such low levels. We analysed our strengths and weaknesses and the environment we had, and took into consideration the climatic conditions. We did lots of budgets on different enterprise mixes, Dorpers, crossbreds, fine wool merinos. At that time we were in the process of moving from strong wool merinos back to medium wool. I guess we felt that the wool market had been oversupplied and that the natural market forces had really been interfered with, and that therefore there was some upside for the industry. We did assume there would be a recovery at some point, because people had started to exit the wool industry and the floor price scheme was long gone. So we really, I guess we made the decision to continue along the path that we were going on. So yeah.
Well, it sounds like you thought about it pretty comprehensively. You obviously did factor in any impact that droughts and low prices might have on your business going forward.
Yes, we did. Absolutely. We've been dealing with it during that period already, and we've always been quite conservative with our budgeting and always kept in mind that we're operating in an 8-inch rainfall.
Yeah, that's right, yep. So how's it working out? Did what you thought might happen or could happen end up being the reality or not?
Yeah, it has. As I said, we made the decision to keep going on the path that we'd chosen. We have met our financial commitments. We've educated our children. We're nearly finished. Jack's still at university. Eddie's now at home with us, which is fantastic. We've continued on our infrastructure program, and we've increased our off-farm assets as well. So, it has worked very well.
Excellent. Thanks, Alex.
Great. Thanks for that, Alex. We really appreciate it. So, I might just hand over now to Phil. I'll give you the presenter's rights. If anyone has any questions for Alex, then feel free to send them in. But I'll just do a little bit of work behind the scenes to get Phil as the presenter for the next session. So Phil, have you got the option to show your screen now? Fantastic.
Yeah, I've just clicked it. Yep.
Yeah. We've just got one question come through for Alex, if you don't mind. It's Alex, did you do succession planning, and if so, when did you start?
Well, we were never sure exactly what the children wanted to do. They've always been interested in the business, and they needed to have a certain level of understanding of what we were doing. Eddie came home a couple of years ago now, and yes, we have started. At the moment we're collating, well, I suppose we're gathering information and trying to work out the best way to do it. We've all sat down and everybody understands what everybody else requires over the next, 10 to 20 years. So yes, we have embarked on it. We're not there yet. We've certainly still got a lot of work to do.
Great. Thanks for sharing that, Alex. So Phil, your screen is showing now, so take it away.
Okay, thanks Penny. Every farm business anywhere, it doesn't matter whether you're growing bananas in Queensland or you're in the pastoral zone, it doesn't really matter. Every farm business has future liabilities, and for the business to survive, especially to survive generation transfer, those future liabilities have to be adequately funded. Now, that puts a lot of pressure on families because the here and now is so overwhelming at times with all the demands on working capital. It's really difficult to put money aside and think about events that could be 20 years or more away, but unfortunately it has to be done. So the major liabilities that we see most commonly are the following. Number one, you've got to be able to pay off debt principal, and I'll talk a bit more about that when we get to it in detail. You've got to be able to do that. You can't go on with interest-only loans. The real cost of a loan is not the interest rate, it's how long it takes you to pay the principal off, and if you don't pay it off quickly, that interest keeps building up, and effectively the amount of money you've borrowed doubles over time or even trebles. So that's the first one. You've got capital expenditure. All farms they're like the Cookie Monster. You keep throwing cookies at them and they'll still keep eating them, and an appropriate level of capital expenditure is needed to keep the place functioning properly. For pastoral people, this is a real issue, and it doesn't matter whether you're thinking of sending the kids off to your state capital city for a private education, or whether they're going to a regional centre for a public education, it's still going to cost if you're on a station somewhere, either of those two options. We'll talk about that when we get to it. Business succession, if it's applicable, you really have to have the funds here to make this happen. In my experience with this issue, most of the family breakdowns and loss of sibling goodwill and all of the issues with badly managed succession can be overcome if there's adequate funding for it, or largely overcome. Tied closely to that is independent retirement. So succession isn't complete really till the older generation are effectively off the place, or they're not drawing on the farm business anymore, and to be independently retired so that they don't draw on the farm business, that requires funding as well. So that's the list. Now I'm going to show you how all this works in a minute with a spreadsheet, and in that spreadsheet there will be some assumptions and things that I'll just get out of the way now. They mightn't make a lot of sense right now, but it'll become apparent when we get to the spreadsheet. So if you're funding future liabilities, you've got to be putting money aside each year, a sum of money, and that really has to be invested. You can't have it sitting there doing nothing. And so the investment process is part of funding long-term liabilities, and it's a good skill to acquire because you should be investing off farm anyway as a matter of principle. So here are some of the issues that will come up with that. I'm going to be recommending that investment be done with equities, the share market. And some people will recoil with shock and horror at that, but I'll explain it in a moment. It's better than fixed interest. Fixed interest at the moment is not even keeping up with the inflation rate, and it's more liquid than property. But if property is your thing, then that's fine. It doesn't matter. Just remember that when you need the money, sometimes a property investment can be take a while to sell to realise its value. In recommending equities, I'm not here as an investment advisor, and so I'm saying do not try to pick individual stocks. And if you don't know what you're doing, more than likely you'll get burned. And so what I'm suggesting is that if you, when this session is over, if you Google Vanguard Australia, you'll see on the website that it's a very big manager of indexed funds. That is, the funds are indexed to the market, and you are guaranteed of getting market performance. And we'll be talking in terms of 20 and 30 years of doing this before the money might be needed. And over that period of time, the index fund approach will deliver exactly whatever the market is doing. They don't try and pick stocks. They just set their index funds up to mimic the All Ordinaries Index, and as a result of that, because they're not actively managing it, the fees are very, very low. And 85% of the time, an index fund will outperform a managed fund. In other words, 85% of active fund managers cannot beat the market after fees. So this is a sensible, low-risk approach for the long term, and all you do is buy the units and let them sit there. So that's going to come up in a minute. So I'll now get out of this and go into the spreadsheet and get underway. Now, this spreadsheet is a spreadsheet-based tool that we use in advisory work, but it's also part of the Business Edge, two-day Business Edge workshop that we're just about to launch for Southern Australia, and we'll be going out to just about all the places where you folk listening today are coming from, and other areas as well. We've had a northern one running for over 4 years now, and MLA say it's the most successful course they've run. And this tool is described in one of the sessions in that course, and if what this tool does is of interest to you, then all I can suggest is that when you hear that one of these Business Edge workshops is coming up somewhere near you, it would be worthwhile attending. So we're looking at any business here, and we'll start off up the top with a tax rate of 30% on income. I've put in the 6.6% as the interest rate that will be somewhere near the mark for today. The cash rate is lower than that, but by the time you take the margin into account, actually we might make it 6.5. And we'll give this business, we'll give it $700,000 of debt. Okay, so now we get down into the funds that are going to be needed for the future. Ignore the line owner drawings. That only gets a positive entry if the owner drawings haven't been put into the expenses over here, which they have been. So there's no need to do anything with that. There's not time to go into this now, but in the Business Edge course we come on quite strongly about once you have a debt term that goes over 10 years, in other words, it takes you 15 or 20 years to pay off, every year you go beyond 10, the debt becomes progressively more and more expensive. And so as difficult as this may be to accept or swallow, we're suggesting that this debt needs to be paid off in 10 years. So I'm going to put that in. So you can see here that when I enter these, the years column, it does the calculations automatically. So in year one, if I've got a $700,000 debt, I'm going to be paying, and I've got a term loan over 10 years, I'm going to be paying that amount, $45,500 in interest and $52,000 in principal. And those numbers change slightly as the period goes on, but they're reasonable numbers to start with. We'll make the assumption that the annual capex spend in this business to keep it functional, replace worn-out stuff, maybe do a little bit of development, but that capex is going to be $110,000 per annum. Now, if the place is running properly, the cross-check with that is the amount of depreciation that your accountant calculates, and the two numbers should be fairly close together. Now, we're going to need that next year, so we'll leave that at 1. Reserves we'll ignore for the moment because there's too much to talk about with the next 3. I'm going to assume, for the sake of this exercise, that the family involved in this business has 2 kids, a son and a daughter, and they're both going to go away for their schooling to a capital city, and it will be private. Now, they're my assumptions. If that's not the case for you, then you can enter the appropriate number here. But if we send that son and daughter down to a capital city now for an education that will involve boarding from years 7 to 12, consensus in all the workshops we've run in throughout the whole of Northern Australia with this, that's going to cost $600,000 for those years 7 to 12. That's for both of them. That includes school fees, boarding fees, uniforms, trips down to see them, all the stuff that you incur when you take on that responsibility. I'm sorry, I put that in the wrong cell. I'll just put it down here.
No worries. Phil, can you just clarify what CapEx means?
Capital expenditure. I'm sorry, it's shorthand for capital expenditure. That is, let's say you have a mono pump and it fails, and you decide to replace it with a solar. So the money that's solar cost to replace it is capital expenditure because it's a new item replacing an old thing. If you repair the mono pump, that's repairs and maintenance and is a normal operating expense. So CapEx is capital expenditure.
Thank you.
Now that will assume that this young couple that have this farm have these two kids now that are quite young, you know, they're 2 or 3 years old or 4 years old or whatever. They're of that age, and we really won't need this for about 12 years. So I'm going to put, it's going to be needed in 12 years' time in there. I'm going to assume, and I'm not being sexist or anything here, but I'm going to assume that the succession plan is simple and straightforward. They're not all like that, but the son is going to get the property and the daughter is going to be compensated as fairly as possible with a range of payments if that's the way it's going to work. So the first thing is some sort of payment to her at the time the son inherits the place is a really good idea, and then afterwards it can be levelled up with the parents' estate when they pass on. Whatever's in that estate can be used to level it up. And the irony of all of this is that 9 times out of 10, if the daughter is financially astute, by the time she passes on, she'll end up wealthier than her brother. That's the way it works. So I'm going to suggest, for the sake of this exercise, that we'll put $1 million in there. That's what she's going to get. And how that is structured is up for discussion. We'll say succession is 30 years away. Now, for retirement, ideally it should be done through superannuation. I'm a great believer in not drawing from the farm accounts for family drawings. I'm a believer in that the owners should be on a PAYE system and superannuation is paid according to that. So there's a few issues here. When you look at how much you're going to need to be independently retired, and you've got succession as a potential family issue, it's important to try and preserve as much of the capital in the parents' estate as possible so that the daughter can be treated fairly down the track. If that's the case, if you want to have a retirement fund where there's enough money in there to live off the dividends and interest and leave the principal intact, in today's dollars, you're going to need $1.6 million. And that's going to be 30 years away as well, because succession and retirement are intimately linked. And we'll forget other. So getting back to retirement, if succession's, there's only one child and it's not an issue, and you're able to let your capital in your retirement fund, your super, run down over time so that by the time you pass on there's next to nothing left, then you only need about 900,000 in it roughly, depending on your the lifestyle and so on. But I'm assuming here that if there's 1.6 million there, a couple should be able to live fairly comfortably in retirement on about $60,000 a year tax-free, which is about what the dividends would be on a super fund with that magnitude. And this, of course, assumes that the parents own their own home and car. So we're in the process of setting this up now with the numbers, and of course, this is my scenario, and I'm plugging in numbers here that are suitable for this presentation, but they might be a long way away from where you're at. And the last one to fill in now is the return on the investment. So for these three here in particular, 12 years away, 30 years away, 30 years away, they're a long way away, and you've got to look at if we're going to do this in equities and go and get an index buy into an index fund and just let that compound away and be guaranteed of average market returns. Over the long haul, or the last 30 years or so, the share market has returned about 10% pre-tax. It's a little better than that when you take dividend imputation into account, but let's not complicate it with all that sort of stuff and just work on a simple figure of 10%, which is a heck of a lot better than fixed interest. Now, we've got to take the tax out of that, so the after-tax return is going to be 7. Okay, so let's take kids' education. This is saying if we want $600,000 to be ready in 12 years' time, we have to sock $32,500 away each year into that fund and have it compounding at 7%. And similarly, these things here. Look at how low these numbers are. You know, for succession and retirement, look how low they are. Because we've started early, 30 years. I'll change that retirement to 10. See what it does. Quite dramatic. So the key here, and this is the problem, the key here is to start very early in your ownership tenure to start provisioning for these things, and when you do that, it's eminently affordable. If you leave it too late, those numbers over there become so big, it's just an impossibility. Right, so what we do now is add up all the numbers in that column. This is the annual allocation we have to make. Note that CapEx is the biggest one by a country mile. Why? Because we need it next year. You may think that that's probably too much by way of CapEx, so let's knock it back. We'll make it 80,000. All right, so we add all these up except that interest figure. So everything that's black here gets all added up, and the total is $189,411. That interest of $45,500 goes in over here. That's why it's not added. So that figure there has to come from the net profit after tax, after you've paid all your operating expenses, you've paid your interest, you've paid your tax. What you've got left over is called working capital, and that's what will be needed on average each year for this particular scenario. Once I know that, I can back calculate I'm going to be paying that much in tax, pre-tax, interest, earnings before interest and tax. I'm assuming that the expenses are going to be a little bit more than historical, and just by back calculation, and the spreadsheet does it automatically, you can get back to what your gross revenue needs to be. And over here, you can get this out of your tax returns if you like, or preferably out of a set of management accounts that you are running on the business to make sure you understand what's really going on. There's your 5-year historical performance, and in this particular scenario, the net profit after tax is $227,000, and it looks like the family needs here are going to be met with some margin of safety. So it's all looking good. Now, if I change this around a bit, if I wake up that, gee whiz, the kids are only 5 years away from school and I haven't done anything, I'll put 5 in there. And down the track a bit, I realise that, I haven't got 30 years. I've only got 15. I've left my run too late. If I do that, and I then look at the result, we're in serious trouble. There's no way in most businesses that you can improve the performance of the business by that gap, which is a bit over $100,000 net profit after tax. We've got to get another $200,000 or more in in sales to do it compared to historical, and it's virtually impossible. So the big message here is be aware that these liabilities are out there, as far away as they might be, and as irrelevant as they might be at the moment. They are going to loom one day, and believe me, this one here, succession, if it's badly managed and not provisioned for properly, it can destroy the business and destroy the family involved. And a lot of work has got to go into that. You know, human relations things, people talking, roundtable discussions, family goals, all of those sorts of things, but it does need financial provisioning. So this tool pretty much tells you whether you've got any chance or not, or what you have to drop out. So I'll just have one more thing in here before I stop and take questions. Firstly, we'll put these back to what they were originally, and it was 30, and that was 30. And there's one other thing that this tool can do. It can tell you how much debt your business can afford. So remember that number there, that 189,000, has to be below that 227. That's the historical performance average over 5 years. Let's bump this up to 1.5 million and see what happens. So we've now gone over that figure, 227, by a whisker. So the safe level of debt in this business, which we put in originally at 700,000, the safe level of debt that's going to make this achievable and have all these other things happen is probably going to be around about $1 million, to leave a little bit of a margin there. So, yep, we're just scraping in under. Now, it's easy to get seduced and break that rule that I mentioned earlier. Let's try and make it easier. It makes a huge difference. It makes a huge difference. And you can be seduced into thinking, oh, I'll go for the 20-year term, and that number then is easily achievable. The problem is that if you do that, you can pretty much kiss goodbye over that period all of the capital gain that will come with increasing asset values, land prices in particular. When you start extending the terms out on these loans, the additional cost of that loan through paying all that interest out to the bank pretty much erodes all the capital gain you're going to make. So you need to bear that in mind. So I'll just put that back. And Penny, I think I've said all I can on this.
No worries. I've just got one question through that. So what does a producer have to do if they've got no chance of achieving their required gross revenue?
Yeah, I know. Look, I built this spreadsheet over 10 years ago now, and sometimes I wish I'd never had, because this can be very confronting. You sit down across the table with a family and enter stuff into here, and suddenly it becomes patently obvious that the dreams and aspirations that the family had are unachievable, and the gross revenue is just completely out of reach. And that's hard. It's emotional, and it really knocks people for six. And really, Penny, all I can say is that you're better off to know that and face the reality of it and make some hard choices than go on deluding yourself and have the whole thing blow up in your face 20 years down the track. It's difficult, I know, but that's about the only answer I've got.
Yep. So one other question, well, one question that's come through is, what does EBIT stand for?
I'm sorry? Earnings before interest and tax. So we avoid the word profit. It appears up here in gross profit. It can be here in pre-tax profit. It can be here in net profit after tax. And if you put it in here as well, it becomes awfully confusing. There's about 3 or 4 different ways the word profit can be employed and used. So to try to avoid confusion, we've adopted the language here. This is financial literacy stuff. The language that's used out there for all publicly listed companies and all other businesses, where that word profit is not used on that line. It is earnings before interest and tax. Then you take your interest out, then you take your tax out. You're left with net profit after tax.
One of the other questions is, would you mind just quickly going through each of those, what each of those stands for, just in that required business performance line?
Here, down here, this column here.
That's the one. Yep.
Sales are just gross revenue. So you sell wool, you sell beef, you sell lamb, whatever. That's just the gross revenue from selling what you produce. Now that's well and good, but this figure down here, the gross profit you make, is the more important one, because what happens if you're in a drought and you've got a flock, say, of I don't know, 6,000 ewes, and you decide to sell the flock down. So you start the year with 6,000 ewes, but because of the drought you end up with 4,000 at the end of the year. They're not really sales, those 2,000 that you've sold down. They're part of capital. They're part of your livestock inventory. And if you include them in sales and sell them down, then you can be deluded in thinking that sales figure looks pretty good, but in fact you end the year 2,000 ewes down on when you started, so you're not looking that flash at all. And so the gross profit figure here takes that into account. So in this instance, there would have been a bit of a sell down. That going down there is what, 150,000 less, so there's been a bit of a sell down there. Your expenses fall into 2 groups. There's the direct enterprise expenses, the things that you'll spend on the flock, like shearing and ear tags and all that, or the herd, doesn't matter. And so they're called enterprise or direct expenses. And then you've got all the overheads, the costs that you incur just by owning the place that you can't do much about. They're there. Rates, insurance, fuel and lubricants, all of that sort of stuff. When you take the expenses away from the gross profit, you'll end up with earnings before interest and tax. And you'll take interest out of that. So that gives you your taxable income. So your earnings before interest and tax is that. We'll take that interest out. We're left with that, 302,000. We're paying tax at a tax rate of 30% up here. 30% of that figure is this figure, 90,704, which leaves us with 211,642 net profit after tax. And that's called your working capital. That's what you've got left over to start to do things with. So part of what you do with that will be put towards allocation, and that figure of capex there of 80,000 might be quite volatile because you might be in development phase, and sometimes it might jump up and be double that because you're opening up country or doing what. That money has to come out of this 211,000 as well. So there's some volatility here. It's not going to be stable like that every single year. That's why you need that buffer there. This figure has got to be bigger than that figure. You need that buffer. So have I explained that adequately, do you think, Penny?
Yep, that's right. I think there's been might have been a bit of issue seeing exactly what cell you might have been pointing to at each time with your little cursor. I can see it quite clearly, but few people with other connections might not have been able to see it that clearly, so it's good to just be able to follow along a bit easier. So are there many businesses, family businesses, that are profitable enough to support the requirements that you have outlined there? And what percentage, Phil, do you think?
Very, very few businesses can achieve these things, not because these numbers are too hard and too big, it's because they start too late. The single biggest cause of all of this not working out, in my experience with dealing with this stuff for a long time, the single biggest cause is that the owners did not treat these future liabilities seriously early enough in their ownership tenure. They woke up too late. Now, I'm not pointing the finger or any blame here because it's hard. You know, you've got, you might have some existing debt. There could be a whole range of issues there that are preventing you from stocking too much away. It is difficult. This requires rigour and discipline, and no matter what, you've got to try each year to sock it away. You can see here that the big ticket items are going to be the debt. You've got to treat debt like it's a brown snake and be very wary of it and make absolutely certain you know the number that is the absolute capacity of your farm business to support. And I'll put that back to what it was originally. And you've got to be managing that. If you let that blow out, as I showed you earlier on, these numbers here get very big very quickly. And if you take the easy way out and blow that out to 20 years or more, it's still going to bite you because the debt's going to be too expensive. You've got to make absolutely certain that your CapEx is well spent because it's the single biggest item on that list. And that's a story for another day and a very important part of the Business Edge course, making sure that that capital expenditure is spent so that every dollar you spend returns the business more than a dollar back, and it's actually profitable. That's really important. These things here, all family-related things, education, succession, retirement, look, the reality is they're a breeze. They're an absolute breeze if you start early enough. And I showed you, if you don't, what happens. These things these numbers over here just get so big, they just tear the whole thing to bits.
Yeah, great. Let's just have a look at one more question. Let me just read it. Does the succession figure and retirement figure account for returns you might accrue from investing these monies elsewhere away from the property?
I'm sorry, can you repeat the question? I don't fully understand it.
Does the succession figure and the retirement figure account for the returns you might accrue from investing these monies elsewhere away from the property? So can you invest those funds elsewhere to get those figures?
Of course, but I'm still a bit lost on the question. You are going to be taking that money off farm anyway. I'm suggesting that it's got to be working away independently of the farm. It's very unlikely that if you sock that money back into the farm that you could get a 7% after-tax return from doing that in the farm business. So you've really got to go off farm with it, and it really doesn't matter how you do it, as long as you are putting that money aside each year and getting the required rate of return to make it happen. And as I've said, my preference would be in an index fund on the share market, and over a 30-year term in this example, that'll work out quite well. If you've only got 5 years to go, I'm not sure that I'd go near the share market at all, because there's plenty of periods in the history of the Australian Stock Exchange where the share market has gone absolutely nowhere over a 5-year period. This strategy here is best set up for very long-term investing.
Mm-hmm. So basically the message is start now.
Yep, as hard, I mean, you know, you take this fictitious family here, a young married couple, probably in their early 30s, with 2 young kids, and they're both mad keen to get the business fired up and going and want to get rid of a bit of debt and so on. And you sit down and talk to them about succession and retirement, and it's easy to understand why they think you're probably from Mars. What are you talking to me about that stuff for? That's so far away it hasn't even hit my radar screen. There's too many other things to worry about. And I sit there and say, look, you've got to start worrying about it now, because every day you leave it, it's going to get harder and harder to make it happen down the track. And you know, here in this scenario, it doesn't really matter if the son doesn't want the place in the end. Neither of the kids want it. So you've socked away that money each year for succession to accumulate $1 million 30 years from now. It doesn't matter if succession means the kids don't want it. You've got $1 million more than you had at the start, and you can have a more comfortable retirement or do what you like, you know.
Yeah. Well, thanks so much, Phil. I really appreciate the time and effort you've put into this presentation, and for both the Pastoral Profit presentations that you've been involved in so far. So I'll just take presenter right back. So yeah, once again, thank you so much. It's been an absolute pleasure working with you. So I'll just put you on mute, and yeah, thanks again, and hopefully people have a look at the Business Edge course, as well as linking in with Pastoral Profit to maybe look at some of these factors in their business and start the process now.
Thank you, Penny.
Thanks, Phil. So I think that was a great presentation, and apologies for the questions that we didn't get time for today. We've got some next steps. I mean, go back and watch that first webinar. That's key to some of the stuff that we were talking about today. It gives you a bit broader view, and this has just gone into more depth and helped to consolidate some of the learnings. So the other suggestion is to contact your regional coordinator. This might have opened a whole can of worms for you, and you might want to learn a little bit more about business management and that side of things for your business. So get in touch with your regional coordinator and find out, well, to let them know exactly what you might need and how they can help. The other place is to visit the Pastoral Profit website, www.pastoralprofit.com.au. So that website there will be the hub for all information about Pastoral Profit, and so we'll try and get as much of that sent through online and then sent through via updates to you all. So I'll just flick up finally, let you know that we were recording this webinar today, so that'll be available for you to view. If there's things that you've missed and you want to recover, then that'll be available like the last one was. So that will be coming out within the next day or two. And secondly, I really encourage you and really hope that you all take the time to complete the short survey at the end of this webinar. It's not very long, but we just need it to determine, that we're doing the right things and what kind of activities and the value of this activity for your business. We really love to know that information. So please do finish that survey for us at the end. And finally, I'll just flick up the regional coordinators again. So Heather Smith in Queensland, New South Wales is Mark Gardner, South Australia is Anne Collins, and John Duff in Western Australia. And that website, again, if you do need their details, and they're located on the website. So that's it from me, and I hope you've all enjoyed today. And once again, thank you to Phil for his time, and also Alex. It was great for her, for us to be able to get that producer's perspective. So that's all from me. I hope you all have a great day. See you later.